Last week, India's central bank governor Dukascopy announced retail inflation remains high and is not being helped by India's soaring current account deficit. But today, data showed India's factory output in May fell to the lowest level in 50 months. Joining me to discuss this further is Jayati Ghosh, Professor of Economics at Jawaharial Nehru University. Jayati, what are your thoughts on this and how do you think this will impact investor and market sentiment?
Well, I think the first point to note is that retail inflation definitely remains high, but a significant part of this is not demand-led, as is frequently argued. It's really cost-push. And Indian inflation has been directly affected, particularly by food and fuel prices. Food prices have risen much faster than the general price index. And we have deregulated our oil prices so that we are really following global prices. So as long as global oil prices remain high, Indian consumers are paying very, very high rates, which really doesn't make sense in a very poor country where most consumers are still relatively poor. And this is really driving a lot of the inflation. Now, it is also the case, absolutely, that because we have high inflation, the nominal depreciation of the rupee doesn't really make our exports and imports more competitive because the domestic prices rise even faster. And so we continue to import quite rapidly, and a lot of that import is in final demand, is in final consumption goods rather than in investment goods.
As we know, India's retail inflation is not the only economic aspect threatening to rock investor and market sentiment, with India's factory data now showing output in May fell to the lowest level in 50 months. How do you think this news will hit investor and also market sentiment?
Well, what we're really seeing is what used to be called stagflation, a slowdown in growth, not necessarily a recession, but definitely a slowdown in growth, accompanied by high and continued and sometimes rising inflation. This is a deep concern. As I told you, a lot of the inflation is cost-led, but we have seen that our slowdown, domestic slowdown, has been partly externally driven because the global markets are down, as you know, and our exports are down. But partly it's because some of the previous growth had been driven by a bubble in real estate, in consumer credit. And as that bubble bursts or winds down, we're going to see a decline in domestic growth as well. Now, all of this obviously has to have a negative impact on investor sentiment. Surely investors are not that stupid. They know what is driving this, and they know, therefore, unless there are very significant changes in the strategy of dealing with the economy immediately, this is likely to continue, and things are going to get worse before they get better.
And today, the India rupee traded near an 11-month low over concerns this month the Federal Reserve will cut asset purchases, which have enticed investors to fund flows into emerging markets. If the rupee downtrend continues, how will this affect the Indian economy overall?
Well, I think it is very likely that the Indian rupee is going to continue to depreciate. It's not just the Federal Reserve pulling back asset purchases. It's also that among emerging markets, India had become less attractive for a number of reasons. There's been a lot of bad publicity about the so-called India shining story. And people have realized that the prospects are much more complicated. There are huge issues in infrastructure, in power, in a number of areas, which means that the medium-term prospects are not all that good. So even without the Fed, we were not really being the beneficiaries of a lot of these recent emerging market inflows. Now, if the rupee downswing continues, then very definitely we will be affected in terms of higher inflation, because a number of our important fuel imports and all of that is going to cost more in Indian rupee terms. But it may have an impact on exports. Unfortunately, if the global economy is down, we can't really hope for a rupee depreciation to give us a lot of buoyancy in exports. So I foresee that this tendency I've identified of stagflation is actually going to get worse. It's going to accentuate in the near future.
Lastly, gold showed its first climb for a month straight following a stop in dollar strength. As the debate over whether the Federal Reserve will stop its QE program goes on, What impact could a continued climb have for gold in India, especially as wedding season is hitting right now?
Well, yes, India a century ago said that India is a sink for precious metals, and it remains the case, unfortunately. We have huge imports of gold. I personally have been arguing that we should increase the duty on gold because most of this is unproductive import. There's really no reason for us to import these huge quantities of gold. And to argue that this is something that, Indians have to have for their weddings and so on is ridiculous. We really have to push for relative prices that induce people away from this form of savings and so on. So, yes, the global gold price, as it rises, unfortunately, it doesn't mean that demand in India slows. And as there is economic uncertainty and as there is domestic inflation, people tend to still see gold as their form of flight to safety and a form of physical savings. So unfortunately, it will mean a further addition to the import bill, because unless we actually make very, very strong trade policy measures to restrict gold imports, Indians are going to continue to import gold.
That's all for now, but do check out my interview tomorrow covering the Reserve Bank of Australia decision. In the meantime, stay tuned to Dukascopy TV for the latest financial news and updates from the TV team. Goodbye for now.